All right, good evening. If everyone can hear me, someone just send me a message or let me know that you can hear me okay. I would appreciate it. We've had our technical difficulties with this Discord and streaming. Testing 1 2. Can anyone hear me? Just send me a message. Oh, there we go. Can you hear you clearly? All right, thank you, Elijah. All right, I know there were about 4 or 5 that wanted to attend, but they had dinner plans and other stuff. So I do have the recording going. I think I figured out the bug last time I tried to record the live streaming. Something went wrong, and I think I got it fixed. I'm not good with technical stuff, but anyway, let's get started. So this webinar, a question came through over a week ago from a member, and the question was, and if anyone has a question and you don't have a microphone, just message me on the Discord. So the question was, if this member they have a $10,000 account, and they wanted to know, how can they make consistently, $600 to $800 to $1,000 a month off that $10,000, without having to sit in front of the screen 5 days a week. I guess because they work, but they wanted that extra income every month. So that was the question, and there's a lot of strategies to do that, to make income on your capital. But they were interested in the micro contracts, and they always hear me talking about how I hedge my option trades with ES futures, which is a concept that a lot of people don't understand exactly. Number one, and number two, it's very costly. You need a lot of margin, to hedge your options with futures. So this was the question here. I have $10,000 in buying power, and how do I make between $600 and $1,000 a month in income off of that, without having to spend 40 hours a week in front of the screen? So I'm going to do my best to explain how you do it. I used to do it a lot. I don't anymore because when the trade goes against you, sometimes you're up at 2, 3, 4 in the morning managing your trade, and just something that I don't want to do. Sometimes I will hedge some of my options trades with futures contracts intraday. If I'm losing on an options trade, I'll put on a futures trade just to cover the loss on that, and sometimes you can make even more. So with that being said, everyone should at least understand 2 things about an option contract. Options have intrinsic value and extrinsic value. So the extrinsic value is pretty much the time value, the time decay. That's what you pay for. If you're buying an option 3 weeks out, you're going to pay for that time. The intrinsic value at expiration is the amount that it's in the money, the moneyness. So I think everyone understands the 2 concepts of options and how they're priced. So with that being said, I'm going to use the example that I was putting together for this member, and I actually ended up taking this trade, and let me just run through it and some of you may not understand exactly how this works. I'm going to do my best to explain it. So back when we were testing this low here, I was pricing out some micro December 21st 4,400 puts. And back here there in the beginning of the month, they were trading at $63, which in the micros, that's $5 a point. So that's about $315. So let's say you think the market's going to trade up, and the market's trading at 4,500, and you want to sell some 4,400 puts. So what I suggested to the member and what I did is I ended up selling 5 of the December 21st 4,400 puts. Now these are naked puts. It's not a spread. So for every put, for every micro option put that you want to sell, you're going to need roughly between $1,100 and $1,200 in margin to sell one naked put. All right. And actually, let me change this. I ended up selling 5, but I want to change this to 1 just to keep it simple for understanding. Okay. So you sell one naked 4,400 put. You collect $63. That's $315. Your short strike is down here. So as long as the market stays anywhere above 4,400 by this date, the 21st, you keep all of that $63 or $315. That's yours to keep. And that's the best case scenario. The market can trade down. It can come down to 44.38, 39. It could trade back up. As long as it closes over 4,400, you keep all of that premium. I think everyone understands that. Okay. So, and the 21st comes, it expires, worthless, you're good to go. However, what happens if the market starts trading down? And now it's coming to your short strike. Well, if it starts trading below 4,400, now it's a problem, because now you're going to start losing this credit that you received. And anything below 44.37, now you're actually losing money. So when you sell a put or call, either one, and you take in that premium of $63, think of that as a cushion. You have 63 points of a cushion to be wrong. So, if the market trades down, your break even is 43.37. So, if the market on the 21st closes at 43.38, you're still good. You're going to give back all that premium. And so the point is, you want to keep all of that premium. Once you take it in, you don't want to give any of it back. A, and B, you don't want to lose money on this trade. So how do you sell these naked puts or naked calls, take in that premium, and keep all of that money no matter what the market does, even if it drops to zero? Doesn't matter how far down it goes. And you do that by hedging it with futures. Now, think for a second, not as a retail trader, think of yourself as a market maker. And Paul does a great job explaining this. He kind of explains it from the dealer side, the market maker side. If a market maker sells a stock option, a call option, and the market's trading up, well, now they're trying to be delta neutral. So what they will do is they'll go out in the market and they'll buy 100 shares for every call that they sold to cover that call. So think of yourself as a dealer for a second. Okay, you sell the 4,400 put, and now the market's trading down, and it's trading at 4,400, which is where you sold it. So as the market trades below 4,400, now you're losing this premium. You're giving it back. So what you need to do is you need to have, and you put this in place and you have to leave it, you're going to have a sell stop for one MES contract at 4,400. All right, so let's say the market gets to 4,400. What's going to happen is, if the market trades below, you can be assigned. Options on futures don't settle the same way as the SPX in cash. They get settled in futures contracts. So if you're trading below 4,400, what's likely to happen is you can be assigned a long futures contract. So now you're going to be long MES contract, and it's going to be losing money because let me explain it this way. We get to 4,400, and now you're short one MES contract. So as the market's trading down, your MES contract that you're short, you're making $5 a point. So as it doesn't matter how low the market goes, you're gaining $5 per point on every short MES contract or futures contract that you have. That's going to cover losing any of this $63 in premium. So let's say, for example, the market is at where's my brush? Okay. Let's say the trade goes way against us and the market's down at somewhere down here. Try and keep round numbers. 42.75. Okay. So anything below 43.37, now you're losing $5 per point on that option that you sold, because you're going to be assigned and you're going to be long a futures contract, and anything below this price, now you're losing $5 a point, and you just gave back all of that $63. This is if you do nothing. So we want to keep all of this premium, and we want to protect any movement to the downside. So we sell one MES contract at 4,400. Now we're short, and for every point below 4,400, we're making $5 per point. Let's say the market keeps trading down. That's fine. We're making $5 a point, but we're also losing this premium as the market trades down. If we get below 43.37, now we're going to get back all this premium, and now we're negative $5 a point below our because this is our break-even point. But we're short one MES contract. So let's just do the math so I can show you what happens if the market trades down to 42.75. All right. So let me get my calculator just so I can make sure it's correct. Any questions? Just send me a question. You might not understand this at first. We may have to do it again. It will sink in, the concept, and once it does, the light bulb is going to go on, and you're going to be like, wait a minute, I can't lose money. And technically, no, you can't. If you know how to manage futures contracts, you can't lose any money with this strategy, and I'm going to show you why. And it will sink in. So 43.37 minus 42.75 is 62 points. and we're minus. Okay. So, if we do absolutely nothing, let's say we don't sell this contract, and we just sell a naked put, and we do absolutely nothing, and at expiration the market's at 42.75. Okay, where do you stand? Well, your break even was 43.37 because you took in 63 points, so that gives you a 63 point buffer zone. So here's your break even. So if we close at 42.75, now you're minus 62 points times $5 is 310 bucks. So if you do nothing and the market crashes down here, you're down $310. That's by doing nothing. All right. Hopefully that makes sense. All right. Now, instead, we're short one MES contract at 4,400. So from 4,400 all the way down to 42.75. Let me get my calculator again. Minus 42.75. That's 125 points. So now we're bringing in 125 points on our one short MES contract, and times $5 a point, that's $625. $625. Points. This is dollars. I should use one of them whiteboards. It might have been a little bit easier for drawing this stuff. Okay. So this short contract is going to protect any downside risk on this naked option, no matter how low it goes. So at expiration, no matter what happens, you're going to keep all of that $63. That's yours to keep no matter what. The short contract that's making $5 a point is going to offset losing $5 a point for everything below 43.37. Half of you are probably totally lost right now and confused. If you are, send me a message. If you understand the concept, shoot me a message that you understand it. I'm going to show you another example on the call side as well. Question. All right, I think everyone's with me so far. Oh, there's one. Got it. Okay, good. Yeah, it's simple. The strategy, its simplicity is, but it can be hard to grasp if you're unfamiliar with futures and how options work. So let me pull up, and this was the I sold it. I got 63. So now here's the thing of why you need some capital and why this trader, asked about their $10,000 and how they can make $800 to $1,000 on it. So normally, if you go about 3 weeks out, and I try to look for around a 30 delta, somewhere around there, and at the time the volatility was up, so these were priced pretty good. So you could just sell one put, and I mean this is in on demand. So it was actually 63 at the time, and this will kind of show you, your max profit on it, and it'll show you the cost, and it'll show you the buying power about how much margin you're going to need to sell that naked put, which is it's around between $1,100 and $1,200 for every naked put or call that you're going to sell. Now, keep in mind that you're also going to need margin for if for the futures contract that you may have to hold overnight, and the margin requirement for every micro contract is $1,265. So for every naked option that you want to sell that you need to protect, just ballpark, you should say you need about $2,500 in your account to be able to do this strategy. So this member said, well, hey, I have 10,000, so that means that they can sell about 4 of these per month. Or, like in this case, I took the same trade here, and that night the market happened to just fly up, and within a couple days it was trading at like $17, and I just bought them back and closed it out. So sometimes this will work quick within a couple days. Sometimes you have to hold it to expiration. Sometimes it'll go against you, and let me show you an example so you can kind of visualize it, because this one you can't visualize. I want to do one where you can actually visualize it so you can see what happens when it goes against you. I think you'll understand a little bit better. Question. I understand the concept, but it's very tricky to actually execute in real, because you will get whipsawed as price moves back and forth against you to hedge with the future. Yes and no. And Tommy, that's where you need some experience trading futures comes in. And, don't forget, you have 63 points of cushion to play with. So, when the market gets to 4,400 and, you go short, the market goes to, 96 and trades back up to 4,403. You get whipsawed a little bit because, as the market comes back up, you want to buy back that contract. You don't want to be short as it's trading up, because now you're losing money. So yes, sometimes the market will kind of get a little dicey around your short strike, but you have 62 points to play with. So knowing the futures, knowing how to trade them and how to manage them will certainly help. But you are correct. Sometimes you will get whipsawed around, and you will lose some of that premium that you took in. But you're not going to lose it all. Even if you lose some of it, that's fine. But at the end of the day, you're gonna keep some of it. All right. Let's go back. Okay. Here's a perfect example. Let's do a call here, and it goes against us. So this is October 13th, and let's say we're looking to sell something around here, around the 11th, and our expiration date is going to be the 22nd. Okay, and let's say we're selling some 44.50 calls. That sounds good. Okay, there's our short strike, and we're selling them down here. And let's just say we sold a October 26th MES 44.50 call. and we got, let's say we got 40 points. That looks pretty good. Okay, and we sell it around. We sell it, even we sell it back here, beginning of the month, and that's about 3 weeks out. That's about how far I go out on these, because you want to try and collect as much premium as possible. All right, so we bring in $40. That's $200 in premium. All right. Now, we want to keep all that premium no matter what happens. We don't want to give any of that back. That's the goal here. And for this trader that's trying to put the strategy on, if you sell 4 of them, that's $800. And their goal was to try and make $600 to $800 per month. And now I can tell you right now, some months it's going to be very difficult when the VIX is at 10. There's no volatility. There's no option premium. It's going to be very difficult to get 40 points 3 weeks out. And if you've been trading long enough, you know which months they are, and it can be difficult. Right now, the premium is great. So we're selling one October 26. Here's the expiration, 44.50 call, and we're receiving $40 or 40 points, which equals $200 in premium. So market's trading up. We're still good. We're under our short strike. Now don't forget our break even is going to be our 44.50 plus 40 points. So that's 44.90, which is somewhere up here. I got another question. Very smart strategy. Can you do this with a strangle or a straddle or something like that? Not sure. I've never done it. This is all I've ever done. So, all right. But I did this for years. I did it with ES contracts. It's very costly to do it with the ES. Every contract, you need about $30,000 in your account. But on the ES, you make a whole lot more. The micros, it's a lot better because you only need about $2,500 for every contract to do this. Let's just change our shorts because I want to try where this goes in the money so I can show you a good example. So let's sell a the 44.50 is fine. Let's just and to answer your question, yeah, listen, this strategy is used by many people. Okay, so there's our short strike, and our break even is going to be 44.90. And it just takes actually doing it once and executing it. And what'll happen is because for me, when I started this strategy for like a few months, I was fine. I would usually just wait, and I would usually wait till on the daily, we're hitting 100 or 200 moving average. We're coming out of stochastics, we get a cross. I would just wait for something like that. I would sell the puts down here, and I would never, it would never get threatened. So for several months, the strategy's working great, and I never had to worry about it going in the money and then manage it with the futures until finally it happened. Why do you sell premium on the MES versus buying calls and puts? I don't buy calls or puts. Buying a call or put is, I don't want to say for suckers, because sometimes, with the right strategy, they work. But, selling premium is more advantageous and more profitable. So yeah, I mean, there's probably a lot of ways to answer that question. I don't just buy calls or puts because you're buying time, and I'd rather sell time and have it work in my favor. Okay, so we're trading here down at 42.60. We sold some 45.50. We sold one 45.50 call. Let me put that back up. Oh, I already got it. Down here. So we sold one October 26th. Well, we got to go further out because I want this to go in the money. So we'll say we sold on November 5th. Let's just change that. One. And Elijah, listen, there are good strategies for just buying and selling calls and puts. Maybe buying out of the money. I don't know. If I buy, sometimes I'll buy a call credit spread, or sometimes if we're really overbought, I'll pick up some cheap put debit spreads if I can get them for like 20 or 30 cents. I'll buy 10 of them for a few $100, and if the market really drops, $300 can turn into, 15,000, with a big enough drop. I'll go 30 or 40 wide. And so, all right, so let's do this so we can give it a little more room to run. All right, hope I haven't lost anyone yet. If I have, just send me a message, and I'll try and explain it a different way. It's easy for me because I've done it for so long and I understand it. So, if this is new to you, especially with futures, I know it can be very confusing. All right, I'll answer that separately because that really has nothing to do with this. Yes, margin for naked options is reasonable on the micros. For every naked option, it's going to cost you about $1,100 or so. I believe it's Kathy sent me the formula for it, and you just take the span margin minus the premium received, and that kind of gives you how much buying power you need in your account. And that can fluctuate as well. But just keep in mind that if this goes in the money, you need to be long or short a futures contract. So you're going to need another. And if you need to hold it overnight, if you're in the money now, you have to stay long or short a futures contract. So you're going to need the margin to carry that futures contract, overnight. So, make sure that you have, because this member asked, well, can I just day trade the future? Well, no, because, if the market closes and gaps up 20 points, you need to be long or short and stay long or short. So for every one contract on the micro, just make sure you have about $2,500 in your account. Just a quick note, I think you have the top line at 45.90. Oh yeah, thanks. Duh. Oh, so I didn't have to change it after all. All right. It's been a long day. I'm tired. I'm sorry. But thanks for pointing that out. I appreciate that. Okay. Now we're set. So we're over here. We sold a 45.50 call. We took in 40 points. Our short strike is 45.50 right here. We have 40 points of cushion, which our break even is right here, 44.90. And our expiration is all the way over here. And guess what? Now the market's trading up. And we're like, all right, we can start losing a lot of money because for every point above 44.90, now you're losing $5 a point. So at expiration, the market's up at 46.90. that's 200 points. That's $1,000 loss. 200 points times $5 is, minus $1,000. So how do we not lose that $1,000, and how do we keep this 200 bucks? So we're going to have, now this time, being that we sold a call, we're going to have one buy stop at 44.50. So we're going to get long one MES contract at 44.50. So as the market trades up, now we're making $5 a point. Once we hit our break even, you're going to be assigned, now you're going to be assigned a short futures contract, but you're also going to be long one. So it's an offset. It's a complete wash. Everything above 44.90, you're making $5 on one, but you're losing $5 on the other, which is a complete wash. And at expiration, you're just going to close them both out. But at the end of the day, you're still keeping this 40 bucks no matter what happens. And that's the whole point, is when you sell the option and you take in the 40 points, you want to keep that. You don't want to give any of it back. And to do that, you're just using a futures contract to protect any risk to the upside. Doesn't matter how high it goes. That long future is going to protect. You're gaining $5, but then you're also going to be losing $5 for everything above 44.90. Does it make any more sense seeing it this way now? Does that make sense? I was thinking today how to try and explain this or teach this. I understand the concept well. I've done it hundreds of times. It's a lot easier when you actually do it yourself. The first time that it goes in the money is a little nerve-wracking because as the market can do this right here, and this will happen. Let me zoom in here. So you get long, and that's great. But when the market comes back down now, if the market starts trading below where you got long, now you're losing money. And the point is to not lose money. So, when the market comes back down, now you're long one. When the market gets back to 45.50, now you need to sell that contract because you don't want to start losing money. So now you sold it and the market trades down. Now you have to put your buy stop back in place at 44.50. So if the market trades back above, now you need to be long again. So yes, there are times, and it's happened to me, where you can get kind of whipsawed a little bit. And during this process, you might lose a point or two because on the smaller time scale, let me pull up the question. On the micros, when assigned, they only assign one contract or more. It depends on how many you sold. If you only sold one, you're going to be assigned one. You're going to be short one. So if you sold 5, you'll be assigned 5. It's per contract. So yes, the trickiest part about this strategy, and believe me, if you trade futures, or if you've been trading futures long enough, it's easy to do. But if you're not familiar with futures, then I highly suggest that you get familiar with trading futures, paper trade futures for a while, because once you know how to trade futures, this becomes extremely easy. I don't want to say extremely, but it becomes very easy. And the more you do it, the easier it gets. This is all I did for 2 years. But there's going to be times that, you might not sleep for 2 days straight. The market's kind of trading right at your short strike, and it's just hovering there, up and down, and you're up all night watching it. You're getting long, you're getting out of it, you're getting short. So that's one reason I don't really do it anymore. And I just stick to, like today, get in, one trade, 30 points, out, done for the day, call it a day. And I don't do the longer term trades anymore. Question, yes, that's what I was saying earlier. I've tried this before with ES options, but have never been able to avoid getting whipsawed. Hedging works well if the market just continues to trend. Yep, it does. But it will bounce. Like what happened today with 20 points in the last 20 minutes. Yeah, that's why I keep telling some of these guys and gals that they like to sell those, spreads, those 15-cent spreads, 5 minutes to close or whatever. And, like today, the market moved 10 points the last minute or two. Not my kind of risk to try and make $15 and risk $500 and take a max loss, but to each his own. That's fine. So yes, to answer your question, there will be times that there will be whipsaw, but just keep in mind, you have 40 points to play with. So if you get whipsawed, and you're losing 3 points here and 2 points there, and all that, that will happen. But another thing is, trying to pick a good location, like the whole round numbers, yeah, I can hear you. Oh, or not. I thought you were talking. Then it comes into support and resistance, and trying to pick a location, and bringing volume profile into it, and kind of knowing what areas are just kind of slice through and not have a chop zone around it.
In front of the drop off in the light.
Oh, I'm sorry. What were you saying?
Come on.
Oh, someone's got his mic on.
Come on. Come on, Michael. Come on.
Sounds like they're calling a dog or something. That's where technical analysis comes in, and we can work on that on another webinar. I want to keep this to under an hour. Of knowing support and resistance, and when I used to put trades on like this, I would spend time trying to pick a spot, knowing that it's not going to hang around that area, and doing that will help the whipsaw, if that makes sense. Knowing your TA, learning volume profile, going back and just looking for spots, that are better to, and then you'll pick your strikes better. I just wanted to try and get the concept down to explain it, and let this sink in first. And once this does, then we'll work more on it about how to manage the futures. Because yes, listen, you can go. I've gone. I think the longest streak I went was like 7 months, where I didn't have anything threatened, and to do that, know your TA, work on your longer term, your 4 hour, your daily, your weekly, your monthly. I used to just wait, and I would only do this, when we had a nice sell off, like here, or when we hit it like around a big moving average. Or I wait for the daily, the MACD to cross back on a daily or weekly, and I would just sell the puts, because usually the market goes up, over time. If you go back and you look to all the times, where we came down and we hit a moving average, I would just wait for those times, and I would sell the puts down here, and I never had to worry about it. But there is going to come that one time, where, let's say you do it here or here, and the market's going to come down, and you're going to have to manage that future. So you're going to have to know how to do it. That's why, trading futures or paper trading them, and learning the ebbs and flows of the futures market, That's why I got so good at trading the SPX options, because I know the futures so well, and I trade the options like I trade futures. And I'm not trying to brag or boast, but my win rate on SPX options is like 90% win rate. Just because I know the futures market so well. Like this morning, the game plan. I mean, everyone should have made a killing today. I said if we break pre-market support, especially 4,700, where's it going? We're going right to S1, and that's right where it went. And I have a few traders, some that are in the mentorship program, did very well. They got short on some very easy strategies and signals that I've been teaching them, and they're doing well. And they're learning how to get short. Even I got short at 9 o'clock, just based on the looking at the 4 hour today. And I'm not trying to get into today, but looking at the 4 hour, pre-market. Even though the longer term bias is bullish, looking at this cross here on the 3 and 8 and this candle, it just looked like it's going to be a down day. So I took the short earlier, and it paid off for 30 points. And so getting back to what I was saying, that's just knowing the futures market, trading it for 10 years. If this is a strategy that you think you want to try and do, I can tell you it works. I can go back, 7 years and pull out, years worth of P&L statements to show you it works. Sometimes, especially in a nice bull run for months, it's going to work great, and you're going to have income every month, and you're not going to have to worry about trading the futures. But you have to know how to do it for when it happens, because eventually it will happen. The market will sell off, and you're going to have to get short a futures contract. I recommend, if this is something you're interested in, try it for 1 month in a paper account, and do it where you intentionally are going to you're going to have to go long or short of futures, just so you can see what it's like. And I'll give you an example. Why am I lagging here? Right now we're trading at 46.65. What is the problemo? Man, I got some serious lag. I don't know why. Try selling like a 4,700 call, like a month out. If anyone wants to try this, sell a 4,700 call, 30 days from now, because I think within 30 days we're going to be trading above 4,700. And then once you sell that call option, put a buy stop for one MES at 4,700, and when we get there, see how you manage that trade, just so you can see what it's like if you're unfamiliar with trading futures. But if this is a strategy that you wanna learn and you want to do, with $10,000 in buying power, you can conservatively make $600 to $800, $1,000 a month. It's not difficult to do. Some months maybe a little less when volatility is low. That trade that member was asking, and Kathy was kind enough. I actually didn't know, because I never did it with Think or Swim, that they allow selling naked options, and they do. And so I took this trade. I was asking her to price out and the margin on a naked 4,400 put for the December 21st, and I wanted to know the margin to put together a trading plan for this member. And I had figured it out by the time she got back to me, and I ended up selling 5 of them, got 63 points times 5, and we got that crazy move. And I think I made like 42 points on 5 contracts, and I just bought them back. I mean, it was $800 and something in a couple days, and it kind of brought back the memories of doing that for years. Some days it's like that, we were down here at this major support area on the daily, and that very next Monday, I think it was, market just plowed right up. So that's about it. That's about the best I can explain it. I'll try and think of some better ways, and we could do a part 2. And I got a question or two. Do you have a guideline rule exit? No, I don't. There's really, no book or anything on this type of strategy. Either there may be. I don't know if there is. But it's really just, this is how market makers hedge their when they sell options. That's what they do. They sell options, and they want to be delta neutral, and they're not going to lose money. Market makers don't lose money, so they will go in and they will buy or sell. Like with the SPX, if there's a lot of call, if they're very, Paul explains this well. Market makers will go in and they'll either buy or sell the futures to hedge all the options that they sold. And that's why sometimes we'll see crazy moves on the ES and the SPX. They'll move. That's just the market makers going into the ES and buying or selling a lot of contracts. And then at the end of the day, you'll see the market on close, the MOC, to get their books right once they're delta neutral. And there are some good books about how market makers operate, how they work, how the markets work in general. So it's probably good to have a good understanding of the other side of the game. And that's what you need for a strategy like this, because you need to think like a market maker. Think like you're the dealer. You're selling someone the option, and you don't want to lose money on it. You want to keep all that premium you brought in. You don't want to give that back. You don't want to lose it, and you especially don't want to lose money. It's one thing to lose the 40 or 60 points you brought in. If you lose that getting chopped up in the trade, that's one thing. But you don't want to be negative, going into your pocket, But the goal is to keep all of that premium that you bring in. And, this is how you do it. Let me dig out the book. There is one good book. I can't think of it offhand. And it's, how to think like a market maker, how the market actually works, when they sell options, how they still stay delta neutral. Let me see if I can find the title. Remember that book. I would suggest reading it, getting an understanding of how the market actually works from the option side and the market maker side, and maybe you'll understand this a little bit better. If anyone's totally confused by this, I get it. It took me a while to understand this and figure it out. But once I did, the light bulb went on, and I'm like, man, you can't lose as long as you know how to trade the futures and manage your trade. You really can't lose. Question: in the webinar, you mentioned your mentorship program. What does that entail? That entails, I have a waiting list, so if anyone's interested, send me a message that you're interested. The details are on the website on zerodte.com. I think there's a link to it, or message me and I'll give you the link. What it entails is me spending time with you one-on-one, a lot of phone time. There's a lot of courses out there that are thousands of dollars, and all they do is they send you hours and hours of videos to watch. I thought, if I'm going to get into the teaching side and teach what's worked so well for me for the last 9 years, if I want to try and teach that, I need to be on a personal one-on-one basis with you. We need to spend time on the phone talking. We need to spend time on the phone during live trading while the market's open, so that you can point out, what are you thinking of doing? Hey, I'm thinking of going long. Did you consider this? Did you look at this? Did you look at the 15 minutes? So I can point things out in real time. So it entails, it's a monthly program, goes month to month, and if you need 1 month, if you need 6 months, however long it takes. And it entails weekly phone calls, weekly training here on the Discord, where we'll spend a half hour, 45 minutes, or an hour, and I show you, certain setups to look for, certain other things to look at on other time frames, and when everything lines up, take the trade. You don't think twice about it. You take the trade. And so that's pretty much what it entails. A one-on-one time. Me teaching you, even if we have to start at scratch, with basic technical analysis. We start from scratch, and we get you trading, and we get you profitable, and we get you on a strategy that works, that you can make money on. So that's pretty much what it entails. If you're interested, send me a message. I'll get you some more information. Right now I have 2 on the waiting list. I'm trying not to take more than, I figured I could handle, I thought I could handle like 4 a month, and I'm at 3, and that's kind of like pushing it. I don't want to take on too many, because I want to be able to give you, that devoted time, that and spend that time and focus on you. And if I take on too many, I won't be able to really focus on you and your trading style, because you may just want to trade options, you may want to trade futures. So everyone has a different trading style. I have one member that's really just trading stocks. He likes stocks, and he wants help with technical analysis. So everyone's different. Anyway, I'm going to wrap it up. I think we're going to do a part 2 and go over a few more examples on managing the futures. I know there's got to be a few of you that this doesn't make sense. If you see it a few times, it eventually it will. It took me a few times for it to actually sink in. But when it did, I was like, oh man, I can sell that for 40 or 50 points, and I can keep all those points no matter what happens in the market. All I got to do is protect it by hedging with a futures contract. And that's really all it is. It's very simple. Many traders use this strategy. You have to be able to know how to trade the futures, especially when it when it kind of whipsaws around. And that's why picking certain strikes in certain areas helps, because the market won't spend a lot of time around that area when certain strike prices to pick. So we'll kind of save that for another webinar. If there are any other questions before I sign off, because I'm beat, I'm going to get ready for bed so I can get up and do my charts. I got one more question. Thank you. Great session to start. You're very welcome. Hope you weren't confused. Actually, I've been getting questions, because when I first joined, I'd be losing on an option, but I'd say, no, I'm hedged, I got a future, I'm long a future. And some people didn't understand what that meant. And, they don't understand when I say I didn't lose any money, I actually made money because I'm long or short a futures contract on it, or several contracts. So it took them a while, and I got a lot of questions about that, what that meant, hedging. Kathy, you're very welcome. I know you understand this well, and I know you're interested in this. Any other questions about this? Send me a question, and we, exactly what you don't understand or anything you're confused about, and that way I can prepare another webinar and we can go through this again. And if you just keep saying the same thing over and over, it will sink in eventually. And this is for, that one member that had this exact question. They said, hey, I got 10 grand. How can I make $600-800 a month? I guess maybe they're just trying to cover their rent or whatever it is, or just have an extra $1,000 a month in income, whatever it is. But with $10,000, you can sell 4 naked options a month, and you'll have enough margin in case it goes against you and you have to carry 4 long futures contracts. $10,000 will be just enough to trade 4 of these a month. And as you make money, then you can add 5, and you keep adding. And eventually, this well enough, you'll be trading ES contracts. A lot more money in margin, but you also, you're making 10 times the amount. So if you take in 40 points, instead of $5 a point, now you're at $50 a point and $2,000. So, and you do 5 of them, that's $10,000 a month in income. So, it can grow, it can get there. Everybody wants that Lambo money. I love hearing that. Everybody wants that Lambo money. Too much. Anyway, I'm heading to bed. It's been great spending time with y'all. We'll do another one of these. Anything else that you guys and gals want to learn about or need help with, send me a message and I'll try and put together a little webinar. I'm new to teaching, so I'm doing the best I can. It's easy for me because I understand all this, but to convey it and teach it is a little bit harder, and I've been learning that. But and if you have any suggestions, I love constructive criticism. Send it my way. I'd love to learn more on your levels. Everyone's been asking me that. That's taking me 9 years to perfect. So to try and teach you that, you'd probably have to come move in with me for several years and just trade full time. Sometimes that's just because I know the ES so well, and I just know where it's going to bounce to, and I can adjust my level. And sometimes, listen, like today when it sold off, it traded to the tick. And it's great when that happens. Some days it does. Last week, it was horrible. We had all them false breakdowns below pre-market support, and market would just be at a random spot. Friday was that. It was very frustrating. The fibs weren't working. Nothing was working. Some days it's like that. Some days the levels are off a little bit. Some days they're spot on. So to try and teach that, that would be the most difficult thing I've gotten. That's the one question I've gotten the most of. How do I draw your levels? That's going to be difficult, but I'll see if I can work on something to show that. Some of it's very basic, just the overnight action on the ES. What's the high and low overnight? That's a good place to start. Value profiling, that helps a lot. And then just really knowing the ebbs and flows of the ES and how it trades. And that just takes thousands of hours of watching candles paint. I'm doing this 10 years, watching this and this market only. This is all I've traded. I don't really dabble in stocks here and there. I trade the ES. This is all I do. My mentor was a retired trader from Wall Street who got me started. And one thing he told me, he said, if you want to be successful and you want to trade for a living, I can tell you right now, marry one market. Get married to one market, learn a strategy, and learn it well. And that's what I did. My first year, I lost 50 grand. I was trying to trade every candle. I was after that Lambo money and thought I was going to make $1 million on every day. And then I stopped and I figured out I was just over trading and I was trying to get rich on every candle. And then it all came together, and from there it was no looking back. But marry one market, learn it so you know the ebbs and flows. Some days I'll look at a market and I can just tell what's going to happen. It's going to bounce here, it's going to bounce there, and I can scalp a few points. So anyway, I'm not going to ramble any longer. Everyone enjoy your evening. One more question. Could you please send me the link that you mentioned? Absolutely. I'll send it over now. Any other questions or anything that you want to learn or know about, send me a message and we'll work on that. Everyone have a great evening. And if you're trading tomorrow, levels will be up around 9 in the morning. I'll see you all then. Have a good night.